Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open, a deceptive calm masks a violent rotation as smart money flees tech. Futures are flat, but beneath the surface, a defensive siege is underway. Will the opening bell trigger a tech bloodbath or a value stock surge? Second, GM skyrockets 55% to record high, but a shadow war emerges. CEO sells $73 million as Wall Street piles in. Wall Street calls this a once-in-a-lifetime comeback, but with the CEO cashing out, is this the ultimate bull trap? The opening bell could reveal the truth. Finally, alarm bells ring. 57% of Americans believe a recession is here, triggering a crisis of confidence. This vibe session is becoming a self-fulfilling prophecy, and it's a critical warning for consumer stocks. Will retail giants face a bloodbath at the open as this sentiment bomb finally detonates? A deceptive calm hangs over Wall Street this New Year's Day. While the headlines celebrate double-digit gains for 2025, the smart money has already left the building, or specifically left the technology sector. The Great Rebalancing isn't just a theory, it is the dominant liquidity event as we breach the 2026 horizon. Investors looking at the scoreboard see a 16% gain for the S&P, 520% run for the NASDAQ, but those year-end numbers mask a violent rotation that began in the fourth quarter. The momentum trade that defined the last 2 years is fracturing, and capital is aggressively repositioning for a much harder operating environment. The final trading session of 2025 perfectly encapsulated this exhaustion. The S&P 500 closed the year at 6,896, stumbling across the finish line with a fractional decline. The NASDAQ composite, despite its impressive yearly performance, is showing distinct signs of fatigue, weighed down by profit-taking in the very mega-cap names that engineered the rally. The divergence is unmistakable. Headline indices are drifting, but beneath the surface, institutional algorithms are dumping high-beta technology exposure and bidding up defensive assets. Why is this shift happening now? It comes down to the collision of valuation, perfection, and interest rate reality. The 10-year Treasury yield is hovering stubbornly above 4.1%. In this environment, the discount rate for future cash flows remains punitive for high-flying growth stocks. The market had priced in aggressive rate cuts, but the Federal Reserve's December dot plot signaled only one cut for all of 2026. This disconnect is critical. Analysts warn that if the 10-year yield breaks above 4.3% in January, we could see a rapid compression in NASDAQ multiples, potentially dragging the index down 10 to 15% as the risk premium resets. The economic data paints a picture of a cooling engine, which complicates the Fed's path. The labour market added only 64,000 jobs in November, a significant deceleration, yet core inflation remains sticky at 2.6%. This creates a trap for the central bank. The economy is slowing enough to hurt earnings, but inflation is high enough to prevent a rescue via cheap money. Furthermore, with Jerome Powell's term expiring in May 2026, the uncertainty surrounding his successor introduces a massive political variable into monetary policy. Markets hate uncertainty, and right now, the future of the cost of capital is an open question. We are seeing the reaction to this uncertainty in real-time flows. Capital is fleeing the crowded technology trade and finding a home in defensive value. Healthcare has emerged as the clear sanctuary. Sector ETFs like XLV attracted nearly $900 million in the fourth quarter alone, outperforming technology by nearly 10 percentage points. Giants like United Health Group and AbbVie are being bid up as institutional managers seek earnings visibility and dividend yields over AI hype. This isn't just a safety play. It is a recognition that healthcare valuations, trading at 15 to 18 times earnings, offer a massive margin of safety compared to the tech sector. Speaking of technology, the cracks in the AI narrative are widening not in the technology itself, but in the stock prices. Nvidia, the poster child of the boom, dropped over 12% in November. While still up significantly for the year, the momentum is broken. At 50 times forward earnings, the stock is priced for perfection in a world that is becoming increasingly imperfect. Contrast that with the energy sector. With oil hovering around $58, integrated majors like Exxon, Mobil, and Chevron are trading at massive discounts to fair value, offering dividend yields that actually compete with treasuries. The market is effectively swapping expensive growth for cheap cash flow and inflation protection. Even the geopolitical landscape is forcing this defensive crouch. Gold prices skyrocketed 62% in 2025, hitting record highs, a screaming signal that global capital is hedging against tail risks, including potential tariff shocks from the incoming administration. As trading resumes tomorrow, do not be lulled by the holiday quiet. We are entering a pivotal window. The immediate catalyst will be the upcoming earnings season starting mid-January. If corporate guidance cites tariff uncertainty or reduces capital expenditure plans, the rotation into defensive sectors will accelerate. We are also waiting for the White House to announce the next Fed chair nominee, a decision that will dictate the cost of capital for the rest of the decade. The playbook has changed. 2025 was about momentum. 2026 is shaping up to be about valuation discipline. The market has signaled its move. Now we watch to see who gets caught on the wrong side of the rotation. The most unexpected news in the auto world today has to be the stunning reversal of fortune playing out at General Motors. While many have been watching the high flyers, legacy automaker GM, ticker GM, is quietly staging one of the most remarkable comebacks on the market. Let's start with a single statistic that might just change your entire perspective on this company. GM stock is on pace for its best year since its 2009 bankruptcy. Shares have surged over 55% for the year, hitting a record high of more than $80 per share. And this isn't a solo victory. When we place GM's surge alongside its peers, the outperformance is stark. Tesla, ticker TSLA, is up a more modest 17%. Ford, ticker F, is at 34%. And Chrysler's parent company, Stellantis, ticker STLA, is actually down 15% on the year. This rally isn't just a GM story. You know, it signals a potential market-wide reevaluation of the whole EV transition. Actually, the big rush to all electric seems to have hit a speed bump. Recent industry data shows that sales of traditional internal combustion engine, or ICE, vehicles are growing, capturing nearly 80% of the market, while pure EV sales have slowed. GM's strength is coming from its highly profitable gasoline-powered trucks and SUVs, a segment consumers are clearly still flocking to. This trend is a major headwind for pure-play EV companies, but a massive tailwind for legacy automakers with strong ICE portfolios. Wall Street is taking notice in a big way. Morgan Stanley just upgraded GM to overweight with a $90 price target. UBS is even more bullish, raising its target to $97 a share and calling GM its top auto pick for 2026. So what's really fueling this Wall Street optimism? It's not just about selling more trucks. A huge factor is a regulatory tailwind here in the US. The Trump administration recently relaxed the corporate average fuel economy, or CAFE standards. This lowers compliance costs and allows automakers to focus on producing the large, profitable gasoline vehicles that American consumers prefer. This creates a strategic advantage for GM compared to automakers in Europe and China, where environmental regulations are much stricter. This also ties into what some are calling a Fortress North America strategy. By doubling down on its incredibly profitable North American operations, GM has been insulating itself from geopolitical risks and intense competition in markets like China. Analysts are pointing to this regional focus, its massive cash generation, and the slowdown in the less profitable EV market as key drivers. And that cash generation is central to the bull case. GM is pivoting to become a value company, meaning instead of pouring all its cash into speculative future tech, it's focusing on returning capital directly to shareholders. The company recently announced a massive $6 billion share buyback program and a 25% dividend increase. For investors, this signals a mature, stable company delivering concrete returns. Right now, a very attractive story in the current market. However, if you zoom out, you'll see another layer of strategy at play that traders will be watching at the open. The situation presents a fascinating duality. On one side, public filings show CEO Mary Barra has sold more than $73 million worth of shares this year. Now, many of these were under a pre-scheduled 10b5-1 plan, which is a defense against insider trading accusations. But the timing, selling a large amount as the share price hits an all-time high, is raising eyebrows. On the other side, GM's CFO recently stated that as long as the stock remains undervalued, the company's priority is to buy back its own shares. This sets up a real tug of war heading into the session. With Wall Street piling in, the big question is whether GM's incredible momentum can overpower these mixed signals from its own executive suite. Watch General Motors at the opening bell. Speaking of a disconnect between perception and reality, we now zoom out to the entire US economy, where a bombshell poll reveals a major crisis of confidence. Despite official data showing strong growth, a staggering 57% of Americans now believe the US is in a recession. That number is up a sharp 11% since February, according to an exclusive poll from The Guardian and Harris, painting a picture of deepening pessimism that could influence the market open. This phenomenon has a name, the vibe session. So the thing is, the lived experience of inflation and high prices is completely overriding the government's headline growth numbers. And this disconnect, well, it could become a self-fulfilling prophecy. If enough people feel poor and act poor, they pull back on spending, and that can trigger the very economic slowdown they're worried about. Nearly half of all Americans, 45%, say their personal financial security is getting worse. That is more than double the 20% who say it's getting better. And the blame is increasingly being pointed directly at the White House. In a dramatic shift, 72% of crucial independent voters now hold the government responsible for rising prices, a 14-point jump since earlier this year. Believe it or not, even 76% of Democrats are now blaming government management, a 17-point surge. Interestingly enough, some of this pain might be linked to recent trade policy. Research shows that recent tariffs are beginning to pass through to consumers. For example, the latest Consumer Price Index, or CPI, saw its largest rise in 5 months, driven partly by higher costs for goods affected by these tariffs. As businesses run out of their pre-tariff inventory, they are forced to pass these new costs on to shoppers, which directly contributes to the feeling that prices are out of control. This sentiment flies directly in the face of recent statements from President Trump, who just last week said that under his leadership, prices are all coming down and they're coming down fast. This gets to the heart of a fundamental question. What even times is times a recession anymore? Technically, the official call is made by a nonpartisan group, the NBER, often long after a recession has started. But what we're seeing now is that mass perception might be a more powerful, forward-looking indicator. When over half the country believes a recession is here, they start saving more and spending less as a precaution. That change in behavior is what can manufacture an actual downturn, no matter the official definition. This isn't just a political headline, it's a direct look at consumer confidence, which has now dropped for 5 consecutive months. The divide is stark, with nearly 2/3 of women and Hispanic voters believing a recession is underway, and 59% of those earning under $50,000 a year reporting their finances are worsening. Now, get this, what might explain this stark divide is a concept economists call a K-shaped economy. Imagine the letter K. For higher income households, their wealth and stock portfolios are on the upward arm, continuing to grow. But for lower and middle income households, their financial reality is on the downward arm, facing stagnating wages and rising costs. This poll is capturing that painful divergence. Ahead of the bell, the critical question is whether this crisis of confidence will hit consumer-facing sectors. Watch for pressure on retail and discretionary stocks as the market grapples with the risk that this widespread negative sentiment could finally translate into a real-world spending slowdown. At the open, look for potential weakness in the Consumer Discretionary Select Sector SPDR fund, an ETF known as XLY. Within that, we could see a split performance with discount retailers potentially holding up better than high-end luxury brands, reflecting that K-shaped reality we just talked about.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.